Hi, old wine in new bottle. The more things change, the more they remain the same or they go back to what they were. I mean, these are cliches we keep hearing from time to time. And why are we talking about this cliche today? Because the government, the central government, the Modi government, has announced the setting up of a development financial institution, the National Bank for Financing Infrastructure and Development. Why is this old wine in new bottle? This is an idea that has been tried before. We have known of institutions that are set up in the past to finance our infrastructure and development needs. So it has made a comeback, and we will talk about the pros and cons of this, whether this can be a success this time around, what is the lesson we have learned from our previous experience. And we have Professor Ila Patnaik here with us. I am YP Rajesh, managing editor at ThePrint. And before I go to Ila, I just want to quickly apologize. We were supposed to start this show at 4 o'clock, but due to some glitches, we could not do that. My sincere apologies. And we will take your questions very soon after Ila is done with her opening discussion. Hi, Ila, welcome. Am I justified in calling it old wine in a new bottle?
Yeah, it's an old idea. We've had development finance institutions before. It is well understood that for infrastructure, bank financing doesn't work. And these are institutions that would borrow from the market and invest in infrastructure projects. Because, if you think of retail investors like you and me trying to invest in infrastructure markets, we won't be able to even assess the risk of an infrastructure project. So these are financial intermediaries who would do that kind of investment. I think this time around, instead, some lessons have been learned from the past. So the government is proposing that it will not stick to 100% ownership. It will also try to raise money from foreigners, from pension funds, from basically from long-term investors or long-term savers who put their money aside for a long term. Try to give them tax-free, tax discounts as rebates, as was done earlier, but maybe bring the management ownership of the government down to perhaps 26% over time. So that seems to be the idea. But I think this was something that has been discussed quite a lot in the last 4 to 5 years. We've also discussed it a few times in our show here, because infrastructure cannot be financed by banks, and that's why the need for something else.
But Ila, if you go back to our experience maybe a couple of decades ago, which is something you talk about in your piece, but you haven't been very detailed there. So I just want to, ask you to explain that. Our experience, maybe in the 60s, 70s, and 80s, we had all these institutions which have become banks now. A lot of the young people may not know about it. ICICI was a development financial institution. IDBI was a development financial institution. There were so many of these, similar. IFCI remains a development financial institution. What was our experience with these state-run or quasi-state-run development financial institutions?
See, primarily the difficulty is that when finance intermediaries are run by bureaucrats, then bureaucrats have various constraints that they face. One is, the biggest is, of course, a political constraint, which is that they come under pressure to give loans to those who the politicians want them to give loans to. You might say that, okay, today's government will not put pressure, its intentions are good, but 10 years, 15 years down the line, you might have a different kind of government where whether it is coalition politics or something else, or corruption back on the table, where bureaucrats face political pressure, and that's a fact of life. And that is something that has, whether it's public sector banking or it is development finance institutions, that has been an issue. The other problem, of course, is fear, that bureaucrats face the fear of investigative agencies, and that they can be charged even after their retirement, in fact, for decisions that they have taken in their tenure as heads of these development finance institutions. So, one way of handling this is to get private management in, which actually does not fall under these sort of bureaucratic structures, but then you do try to get uh, more investors who are represented on the board. So for example, if you have uh, pension funds or insurance companies and many FIIs who invest long term, many of them do, and if they are on the board, they hold shares of this company. If it's not 100% government owned, so slowly the government, while keeping perhaps controlling share and keeping 26%, if the government does get others on board and they have play a role in the board, scrutinizing projects, making sure that excessive risks are not taken and the bureaucracy is not under pressure, as well as at the same time making sure that the management is actually protected from the from investigative agencies. And that kind of, it needs a different environment, decision making environment, and that could perhaps make this DFI different from the earlier ones.
Mhm. Uh, Actually, I will go. I thought I would take questions a little later, but there's a question which is related to what you're talking about, Ila. So I'll take that question from Dharya Nagpal. And this is something you have talked about in your piece. So I will sort of link that, and then maybe you can explain that a little more. Dharya asks, why did India stop its DFI policy? What were its issue? In your piece, you have written that the end of subsidized credit was one of the reasons which hurt the DFI, DFIs earlier. Was that all, or was that more than that, Ila?
So I'm basically saying it's more than that. That
Mhm.
basically they all became loss making. I mean, they all had to be kind of sold off. ICICI, for example, had to be privatized and shares sold off, and it
Mhm.
was not something where the government could keep putting money in. So if we just continue giving them subsidized credit and don't bother about where the investment is being made, or whether returns are coming or not at all,
Mhm.
that was the culture which got them into trouble. Which is
Mhm.
why the argument I'm making is that, apart from the fact that we don't have that kind of subsidized credit, though we would give them some maybe tax rebates and so on, which effectively means subsidizing them compared to the others. But apart from that, you have to give the management both autonomy and accountability, put in checks and balances. It has to be a different kind of management, because the typical public sector management in the institutions that failed to function should not be something that you want to repeat.
My own question here, Ila, and this is again thinking aloud rather, because the earlier generation of DFIs existed in a pre-liberalized era, pre-1991. Do you think that also played a role?
Yeah, absolutely, because there was no private sector that was investing. So again, where did the money go? The money would go into some sort of a public institution, or some public project where it was not very easy for it to recover that money, or even the project to get completed. So one is that today you've got a better system of public-private partnerships, whether you do it at the early stage of the project of projects that has been done, or you do it at a later stage, like now what the government is talking about in this budget, that you buy up projects that are already complete and then you manage those projects, and that's also money for infrastructure, and not just yearly. So both of them are money for infrastructure.
Mhm.
In addition to that, another important thing is that we have better functioning financial markets than we did in 1991. I mean, remember that before 1990, in fact, until 94, 95, interest rates were not allowed to move. They were fixed. The 91-day T-bill rate, for example, would be 4.26%, and that was fixed by the RBI. So
Mhm.
when interest rates were not allowed to move, financial repression was much, much more. So all financial institutions had to have like a 49% SLR,
Mhm.
and financial repression was much more. So we have moved to a much better financial system. We're trying to make our bond markets work. We're trying, equity markets work better. There is far more liquidity and depth in the financial system today than earlier. So today, a DFI might maybe actually be able to go out into the market and raise money through bonds, through selling bonds, even if they are government guaranteed, because it is effectively owned by the government, but it should be able to go out and raise money. A third very important, very, very important difference is that at that time, foreign capital was not allowed in. So you had a completely closed capital account. Whereas today, we are thinking that a lot of the bond purchases can be done by foreign investors. So bonds of this DFI, when this tries to raise money in the market, then that money can be,
Mhm.
those bonds can be subscribed to purchased by foreign investors. And there is a lot of money abroad that is looking for long-term high returns, which is something that we should be able to provide through this. So I mean, the environment is very different, and therefore that also improves the chances of success of this
Mhm.
initiative.
So I was about to touch on that, Ela. So the environment is different. The environment has changed. Financial, economic conditions have changed, and from what we see in the framework of the new DFI, even the government, the policymakers seem to have learned from the past. Does it look like that?
Yes, it does in terms of so for example, right in the beginning, they're saying that we'll take government ownership down to 26%. Okay. So that tells you that it is not that we will forever be 100% till things break down and we have to sell off. So just the understanding that you need to have private ownership, private participation, maybe private oversight over the management is something that is healthy, because that was not something that was there in the past.
Mhm.
So that brings its own checks and balances.
Mhm. We have a lot of questions, and we'll go straight dive into the questions because we have to wind it up before 5 o'clock. We have another live coming up after that, so we'll dive into the questions. But before those questions, I have my weekly request to make to all our viewers. Please subscribe, take subscriptions to the print. We bring you quality journalism, quality discussions, quality analysis, and you are quality viewers, quality readers. So we need to have a quality relationship. Let us pay for what we read and watch on the print. Let's subscribe to it if you have not already done so. And if you have taken a subscription, please spread the word. Tell your friends, tell your family to watch us and subscribe to us. And you will be doing good journalism a great deal of help and service. That is my message for this week. I'm going to uh, Karma Man. I'm sure that is not his name. That is a pseudonym he uses. Uh, Ila Karma Man wants a simplistic, very simple explanation of what is a DFI.
Okay. So a financial institution, which now this is a development finance institution. Why do you use the word development? Because it is going beyond commercial borrowing of the kind you and I would do. And what does it do? It's a financial intermediary. So it's a financial intermediary that will not just invest in the projects in which banks invest, but will be looking beyond that. And in this case, since it is a DFI focused on infrastructure, what it will do is it will raise money from the market, means it will sell bonds. It going to hold some equity. So this 20,000 crores and 5,000 crores, which the government has put in through the budget, it will hold some equity with itself, and leveraging that, it will basically borrow from the market, sell bonds. So that will mobilize resources. That money that it borrows, it will invest in infrastructure projects. So, and then the returns from the infrastructure projects will then be paid back to whoever has put money in. This particular DFI will do that for infrastructure projects. And let me point out why a DFI. Otherwise a bank pretty much does that. It raises deposits and then it lends to projects. In this case, it is long-term lending and long-term borrowing. So the bonds are also long-term, let's say 10-year bonds. I don't know what they will be, maybe 5-year, 10-year, 7-year, but long-term bonds. And the lending is also long-term because infrastructure projects take a long time to, finally be completed and give returns. Does that?
I have a question of my own here. Remember, even 5 to 10 years back, the government used to float infrastructure bonds through banks and institutions, which you and I could subscribe, 20,000 rupees, 50,000 rupees, and they were tax-free bonds. 10 years were 4 years, 5 years. Sometimes there were annual interest was paid. Sometimes the lump sum interest used to be paid. Why did that idea die?
So so that was done mainly through either development finance institutions, or it was done through some companies like REC, Rural Electrification, or some public sector enterprise that
NHAI.
NHAI. So that an enterprise that was actually investing in infrastructure. Now, one of the things that was happening was that tax discounts were being given. So effectively, the exchequer lost money on the money that it would have got if those tax discounts weren't given. So Department of Revenue would always be a little reluctant to give that tax exempt status to those bonds. Usually the interest rate was lower, and there was a tax exemption. So it would make it attractive to some extent to you and me to be able to buy those bonds. But then it's not that they've gone. You still see sometimes some bond coming through, but it wasn't exactly the favorite thing for the revenue department.
Sai Kaushik asks us a China question. We can never escape from China. Can you let me know how China financed its infrastructure boom, and what can India learn from it?
Okay, so what China did was give very, very low interest rates to depositors, 2% interest rates to depositors. Okay, so then banks would be forced to on lend at even lower interest rates to whoever the government told them to lend to. And this was almost like a formal system. So basically, if India was not a democracy and you could have pushed down interest rates to savers. Savers are usually, salaried people, households who are able to get middle class households a little, because richer households would go more into equity and other investments. So usually middle class households who save in bank or have the kind of, savings where bank interest rates matter to them. So if we had not been a democracy, I could have said, yes, the lesson to learn is squeeze the middle class get interest rates down to what, 2%, then make banks lend to certain projects, infrastructure projects. Because they don't get much return, those banks don't earn much interest and then don't pass on that interest. So that whole mechanism would have been done if uh, we had not been a democracy. I would say that we can't learn lessons from that because we can't do that. We should not be doing that. It should not be a system of squeezing people who are saving their hard-earned money, not letting them earn whatever interest rate the market is willing to give them. So it's a different
Uh,
model, basically. Sorry, it's a different model. It's a different model of development. And the entire Chinese model of development is different from ours.
Yeah, like I know it's probably not the correct expression Amitabh Kant used, but he used it a couple of months back and said we are too much of a democracy. There is nothing like too much of a democracy, but we are a democracy. So what happens in China can happen only in China, unfortunately or fortunately.
Fortunately.
Mehul Lad has a question. Ila, he says, previous attempts at the same have failed. We talked about it. What can change this time? That is also something we discussed. The last part of this question is interesting. Can the government control the temptation to politicize a DFI?
It's very hard. It's very hard because you sometimes say that, okay, this government, because it has a majority in parliament, might be able to control that, but if you have another next government which is a coalition and it has coalition partners which are not satisfied with the shall we say, ministries where they don't earn excess returns. And infrastructure ministries are always favorites for coalition partners, roads, shipping. I mean, we've seen that story in UPA 1, UPA 2 unfold, where the most lucrative ministries always go to coalition partners. So it's, it's a difficult thing not to uh, to resist that political pressure for a government if it were a minority government. So I know these institutions, once they take birth, they don't really die very easily. So they're going to be around for a very long time, and that is why I think it is very important that we bring down the government ownership of the institution as soon as we can. We strengthen the management structure, we make it more accountable, we make it more transparent. We bring in the kind of private management which is not a bureaucrat who is there on deputation, who has to go back to the bureaucracy and who will continue to be CVC, CAG, CBI, etc., etc., under those pressures. So yes, it is very difficult.
We were just talking about China, and Dipankar Sa asks us, has a DFI policy worked well in any other country?
So I'm not sure that, so there are some examples that are given, but I'm not sure that every other country uses DFIs, especially if a country has a bond market where private companies can raise money for their projects. So, if we had a bond market, then instead of setting up a government finance institutions that would raise money for infrastructure and then would go and invest in infrastructure, which we would really nurture by giving tax rebates. Instead of that, we would have used the bond market. So when you look at examples across the world, this is, we have some limited experience, but not too much.
Ila, we have about 10 minutes and a lot of questions, surprisingly, a huge number of questions. So we'll try and take as many as possible and give you quick answers. Uh, Joydeep Kar asks us, why was ICICI, which was a DFI, converted into a retail bank? You answered that question. Basically, all those old DFIs were running into trouble, financial trouble, and they had to be rescued by converting them into banks. Correct, Ila?
And they were privatized.
And they were privatized.
IDBI, ICICI were privatized.
IDFC.
IDFC. So the first phase of privatization that happened was actually those DFIs being turned into banks. First phase of bank privatization that happened, not
Yash Chandan asks, the government is planning to bring down its stake to 25% in a few years. I think it's 26%. Is this the right approach?
Well, I think initially you do need to see what one might call a proof of concept, whether a DFI would work or not. And so if the government sets it up and it is successful, and then it brings down its stake, because that's when private participants will buy shares in it. So that does seem to be, a sensible path to move on.
Uh, Karthikeya Gupta has a very interesting question. Ila, he says, how will the government ensure that DFIs fund socially acceptable infrastructure projects? Because we have seen examples of DFIs like Hutco, financing golf course and luxury projects.
So, I'm not sure that they should only be financing socially uh,
Acceptable.
acceptable projects, because bondholders who will be putting, in case those projects don't make money and the others make money. I think that's the implicit assumption, because the DFI would basically want to choose projects that also give returns, because after all, it'll be people like you and me who are putting their life savings into buying these bonds, and one would these households, whether they are Indian households, whether they are pensioners from abroad, whether they are uh, you know those who put their money into thinking that they will get some return. See, you do need to consider that their savings are going into this. So the money should go into profitable projects. Now, if whether it's a golf course or a luxury, whatever it is, as long as it is not something that is unethical, as long as the laws of the country are not being violated, as
Mhm.
long as it's a project that is out there, transparent and open, if it is giving high returns, just assuming, because that
Mhm.
seems to be the argument, if it is giving high returns, then why would you or an old pensioner not be given the benefit of those high returns?
Mhm. Mhm. Hitesh Nautiyal, a regular viewer, who comes almost every week. Thank you, Hitesh, for your question. Uh, I will shorten the question. What is the risk of the DFI becoming just another public sector company?
I think there is certainly a risk, and that is what we've talked about in the last half an hour. That if you have retired bureaucrats or current bureaucrats on deputation, or those from public sector banks heading the institution, running it, if the way the recruitment is done for the staff itself of the DFI, and how that staff behaves, all that runs the risk of it becoming another public sector bank
Mhm.
or bank-like institution. So yes, the risk is very high. It has to be that there is a very clear, strong motivation to do it differently.
Ila, we'll take two last questions. We are running out of time. The questions seem to be still coming. Tarush, again another regular viewer. Thank you, Tarush, for your question. Would having a corporate bond market like in the US have been better than having a DFI?
Yeah, absolutely. Because you don't want to come to a stage where you want to set up a bureaucratic institution which runs the risk of becoming another bureaucracy. But the point is that we don't have a deep and liquid corporate bond market. We don't have a government bond market, which is required to have a bond market. So, every time somebody says just a corporate bond market, I like to bring in the notion that what you need is a bond, which has both government bonds and corporate bonds. We don't even have an independent debt management agency yet, which will be the first step towards getting a bond market functioning, because it will buy and sell government bonds. So
Mhm.
we are not, so we choose the second best.
Akhil Shandilya asks us, how can DFI funding overcome challenges such as land acquisition and other delays that have led to the NPA problem in banks?
No, so you see, it's not that the DFI funding solves the problem, but it is that the DFI is expected to have a longer time horizon
Mhm.
than banks. So with banks, the maturity mismatch is much more because banks borrow short, and if they start lending long, then that is why they are expected to hold more capital. That is why they hold CRR, because they can always demand our deposits back at any point of time. Even fixed deposits, certainly current and savings deposit are there on demand, but even fixed deposits, so they are required to hold more yeah, equity for this purpose. Now, what happens with a DFI, which is also borrowing long, which will float bonds which are long, not just take money in short term deposits, is that maturity mismatch problem is not. It is not that that money will solve the land acquisition or clearances issue at all. No, it will not do that.
My absolute last question, Ila, from Ishank Sagar, and my apologies to all the others who have asked questions and I could not take them. We are running short of time. Uh, Ishank says, can entities like DFIs really solve the real problems that plague infrastructure in India? Like he says, for instance, the dedicated freight corridor, which is being built by the Indian Railways. He says, I first read about it or heard about it when I was in class 10 in 2005, and it is still WIP, which I will translate as work in progress. So DFIs cannot solve the execution problem, can they?
Obviously not. So DFI is a mechanism to finance infrastructure projects, not a magic bullet for solving all the problems of infrastructure projects. Infrastructure projects have many problems, including, as we talked about before, land acquisition, including clearances.
Mhm.
And it is not that, or whether it's a problem of execution by the government, project planning, execution, whether tomorrow we'll have issues about whether a particular infrastructure project is disaster resilient or not, whether it is going to cause climate change and worsen the environment or not. There are many, many issues, green, social, many, 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 many issues with infrastructure projects. A DFI will not solve all of those. It's not even expected to. All that it is expected to do is to move the focus away from bond financing, from bank financing of infrastructure projects to long term borrowing, long term for financing infrastructure projects. And so reducing the maturity mismatch. So out of the 100 problems, it is this one problem that the DFI will try to solve.
So, but it is still that one major problem. So, we can talk about the other problems later. Thank you so much, all of you, for watching us today. Thank you, Ela. We had a very good, detailed discussion. I know this is a very technical subject again, but that is what we do at in Ilanomics. We take technical subjects and try and demystify them, and translate them into English as much as possible. We will be back again next Friday with another live episode of Ilanomics. Until then, please do watch our other videos, our shows, subscribe to our channel.